Hello, everyone. Thank you very much for joining us once again. As you know, we are discussing corporate tax, and we are discussing series of webinars on the corporate tax. Till now, whatever we have discussed what is corporate tax, what is the announcement date, what will be the implication on the market. What is the difference between deferred tax assets, deferred tax liabilities, what are the permanent differences, what are the temporary differences, how to calculate the taxable profits, how to convert the accounting profits into the taxable profits. All these things we have discussed till now today. And now we are going to discuss deferred tax assets. And before starting the discussion for the deferred tax assets, just we'll recap all our previous lectures. Then we'll move ahead, we'll start our discussions on the deferred tax assets. So let's start the discussions. So again, just a declaration, the lecture is based on our understanding of the press release and the public consultation document issued by the Ministry of Finance of the United Arab Emirates. We have applied the understanding that we have developed from the best global practices in various jurisdictions. This is not our official opinion. So in our first lecture, we'll discuss about the announcement, we'll discuss about the effective date, we'll discuss tax and types of taxes, we'll discuss taxable profits, we'll discuss key features of the UAE corporate tax, then propose compliance requirements for the corporate tax. After this, we'll discuss these types of taxes, there are direct taxes, there are indirect taxes, and we decided that the corporate tax is a direct tax in nature. We'll discuss what will be the impact of the corporate tax, impacts of corporate tax on the businesses. We'll discuss the impacts of corporate tax on the shareholders. We'll look into the impacts on foreign direct investment, individuals, government, and economy. All these impacts of corporate tax we'll discuss in our second webinar. We'll discuss what is the difference in between accounting profits and taxable profits. We have established and we have decided the difference between accounting profit and taxable profit is due to the permanent differences, due to the temporary differences. Permanent differences are permanent in nature. They create impact in one tax period. It will not have any impact in the subsequent tax period. Then in fact, a temporary difference will have impact in the current period. It will have impact in the subsequent tax period as well. So these are called temporary differences. In the temporary differences, we established there are two types of temporary differences. One is the deductible temporary differences, second is the taxable temporary differences. Deductible temporary differences leads to the deferred tax assets, and taxable temporary difference leads to the deferred tax liabilities. Then we decided how to compute taxable profits. We have discussed two approaches to compute the taxable profit. One is the direct method to calculate the taxable profit. That was decided it can be started from the scratch. We will take the sales, we will take the cost of goods sold, we will take the tax allowable expenses, then we'll arrive at the taxable profits. The second approach that we discussed, it was the indirect method of tax based on the accounting profit. We can convert the accounting profit into the taxable profits. This is the indirect method of calculating taxable profit. We'll add back non-cash. Basically, there will be some sort of adjustment for the non-cash items, non-allowable expenses, allowable income. All these adjustments will arrive at the taxable profits. And we have established, we have decided, we have discussed that in the public consultation document, it has been proposed by the Ministry of Finance to adopt the indirect method, and they have given the various reasons for this as well. We have taken one example. In this example, we discussed how to convert the accounting profit into the taxable profit. We look into this, that based upon this example, my accounting profit was 4.65 million. This 4.65 million we have converted into the taxable profit, and taxable profit was 2.28 million. These all types of adjustment, and we have adopted indirect method of calculation of corporate tax. Then we approach, this is the indirect method, this is the direct method. Both of the methods are giving me the same results, and these results are giving me taxable profits of 2.28 million. So let's start our discussion. This is a new webinar, new lecture on the deferred tax assets. Deferred income tax. What is the deferred income tax basically? This is tax that is being overpaid or underpaid. It will have impact in the future tax period. This is called deferred tax. Like this deferred tax arises due to taxable temporary differences. If we are paying higher tax to the government today, it will arise deferred tax assets. Like deferred tax means we are paying higher tax to the FTA, to the tax authorities today. It will have impact. We will have right to take the tax back from the government in the future tax period. This is called a deferred tax asset in the language of a very layman. Now, deferred tax liability means you will be paying short tax now, but in the future you will be liable to pay more tax to the authorities. So this is called deferred tax liability. Before going into the discussion of deferred tax in detail, I would like to go back again to the slide. This is called the difference between accounting profits and taxable profits. We decided these differences arise due to the permanent differences, and these differences arise to the temporary differences also. Permanent differences incurred in one tax period, it will not have any impact in the subsequent tax period. Like dividend is not subject to tax in UE. Capital gains, these are not subject to tax in UE. Fines and penalties, authorities will not allow for tax purposes to deduct from to arrive at the taxable profit. So these items will create permanent differences. Then there are temporary differences. These temporary differences incurred in one tax period, it will have impact in the subsequent tax period as well. So these temporary differences can be classified into the taxable temporary differences and deductible temporary differences. Deductible temporary differences, your current period accounting profit will be lower, current period tax profit will be higher. Current period tax profit will be higher, you will be liable to pay more tax now, and based upon this, you will be liable to take this tax back from the authorities in the future. This is called deductible temporary differences. The examples are the bad debts provision, warranty. These are the few examples. We'll discuss examples in detail. Then we'll discuss in the taxable temporary differences, your taxable profit will be lower as compared to the accounting profits. Means in the current period, businesses will be paying lower tax, but in the future period, they will be liable to pay more tax to the authorities. So this is called deferred. This will arise deferred tax liability, and the best examples are the prepayments. Now, these deferred tax assets, we have just established in the deferred tax assets, my taxable profits will be higher than my accounting profits. Once our taxable profit, the businesses have higher taxable profits in the current tax period, they will be paying more tax. And there are three reasons due to which your current period taxable profits are always higher as compared to the current period accounting profits. These three reasons are, might be your income is higher. If your taxable income is higher and accounting income is lower, it will lead to higher taxable profits. Second, if your taxable expenses are less as compared to the accounting expenses, again, it will lead to the higher taxable profits. Third thing can be, might be you have the carry forward losses. These are the carry forward losses. Again, it will lead to deferred tax assets as well. So three reasons are there. So one is taxable revenue is greater than accounting revenue. This is the first factor, due to your taxable profit will be higher. Second is taxable expenses are less than the accounting expenses. Once the taxable expenses are lower than the accounting expenses, it will lead to higher taxable profits. Third is business has carry forward tax losses and tax credit. It will lead to deferred tax asset as well. So let's look into This is a detailed discussion. Taxable revenue is higher than accounting revenue. It will lead to, as I mentioned, it will lead to higher taxable profits. Like we'll discuss the examples in our next slide. Like the rent of 3 months is 120,000. One company has received a rent. The value of the rent is 120,000. This rent for accounting purposes, assuming the rent is for 3 years. For accounting purposes, this rent will be amortized over the period of 3 years. But the tax authorities, usually they follow the cash basis of accounting. On this case, whenever the company is receiving the rent 120,000, tax authorities will ask them to pay the rent and the full amount. Let's look into this example. The value of the rent is 120,000 and it covers 3 years period. So in the accounting, it will be deferred. Sorry, it will be amortized over the period of 3 years. So 40,000 in 1 year, 40,000 in second year, 40,000 in third year, total 120,000. If I'm calculating my corporate tax is 9%, so my tax expense is 3600, 3600, and 3600. This will be reflecting in my accounting books. So what the tax authorities will say? They will say you have received a rent of 120,000 in this tax year. You are liable to pay tax on the full amount. So 120,000, this is the total income. They will ask you to pay 9%. Total tax payable is 10800. So you can see in the first year, my taxable profits are higher than my accounting profits. In the first year, my taxable profits are 120,000, while my accounting profits are 40,000. So means in the first year, my taxable profits are higher than my accounting profit. It will lead to deferred tax assets. So company will be liable to pay in the company due to the higher taxable profit. Company will be liable to pay higher tax to the authorities. So 10800 is the higher tax, expense is 3600 based upon the accounting profits. So what will be the higher amount of tax? Higher amount of tax is 7200 because tax payable to the authorities are 10800 and tax expense is 3600. So the differential is 7200. This 7200 is my deferred tax asset. So my tax expense is 3600. Tax payable to the authorities is 10800. This is my accounting entry. And deferred tax asset is 7200. We have already established that if your taxable profits are higher than accounting profits, you will be liable to pay more tax to the authorities right now. This tax, you will have right to take it back from the authorities in the future, meaning in the future, you will be liable to pay lesser tax. So in the next year, assuming again the same situation, accounting profit is 40,000, tax expense is 3600, but my taxable profits are 0. So out of this 7200, tax expense is 3600, who will not be liable to pay any tax to the authorities. This 3600 will be recovered out of this 7200. So my accounting entry will be expense will be debited and deferred tax assets will be credited. In the third year, it will be the same entry. So we decided these are the taxable temporary differences. We decided already it will have impact in one tax period, it will have impact in the subsequent tax period as well. So you just looked at example. It has impact in the first year. In the first year, my taxable profits were higher. We had paid a more tax to the authorities, but in the subsequent period, it has been adjusted. Once it has been adjusted, it has a nil impact over the period of time. Let's look into this second example. Let's look into it. Limited book provision of 3% of the total sales of 100,000. Total sales is 100,000. Based upon the history, based upon the historic results, companies creating a provision 3%. They are expecting sales, 3% sales will be returned back from the customers. So assuming GP is 100,000. GP is 100,000 less provision. Or it should be sales, not GP. This should be sales. Sales is 100,000. 3% is the provision based upon the historic result. This is the provision. The accounting profits are 97,000. 9% is the tax. Tax expense is 8730. Tax expense is 8730. Now looking into tax books. Tax authorities say, okay, they are not allowing the provision. Usually, tax authorities are not allowing the provision. They are following on actual basis. How much the goods has been returned, they will allow it to be deducted to arrive at the taxable profits. So 100,000, company has created a provision in the first year. They have not allowed, so taxable profits are higher as compared to the accounting profits. So my tax payable is 9,000, tax expense is 8,730. So deferred tax assets is 270. Next year, the same thing. Next year, we have created a provision. The company has created a provision of 3,000. It led to the accounting profit of 97,000, tax expense of 8,730. And if I'm going to the textbooks, they are saying actual goods has been returned in the next stage with only 1,000. So my taxable profits are 99,000, accounting profits are 97,000, tax payable is 8,910, tax expense is 8,730, 180. Again, it has created deferred tax asset because my taxable profits are higher than my accounting profits. So I have created again deferred tax assets in the books. In the third year, company has not created any provision. Assume a company has not created any provision, but the actual good that has been returned from the customer, the value is 4,000. Now my accounting profit is 100,000. 9,000 is tax expense. Taxable profits are 96,000. Tax payable is 8,690. Now company will adjust the previous book deferred tax assets. So what the company will book tax expense of 9,000, tax payable 8,690. They will not pay anything extra to the FTA right now in this tax period in this year, but they will adjust deferred tax asset 360. This is how deferred tax assets works. Third example, you can take the pattern of allocation of depreciation may be different as well. Like assets of 90,000 depreciated by tax authorities over 3 years instead of 2 years. Means assets of 90,000 depreciated by tax authorities over 3 years instead of 2 years. Means accounting, in the accounting books, assets is being depreciated over the period of 2 years, while in the tax books, this is being depreciated for 3 years. So my accounting profit 55,000 because this asset has been depreciated over the period of 2 years. Tax expense, tax depreciation 30,000, again 90,000 total. Here 90,000. Asset is being depreciated over the period of 3 years in the books of tax authorities. In the book accounting, asset is being depreciated over the period of 2 years. Again, the value 90,000 of total depreciation. So here again, my taxable profits are higher. Taxable profits are higher. Taxable profits are higher. Accounting profits, taxable profit 70,000. Accounting profit 55. 70, 55. Third year, taxable profits are 70. Accounting profits are 100,000. In each year, in the first year, it has created deferred tax assets of 1,350. Second year, it has again created a deferred tax assets of 1,350. Third year, my accounting profits are higher as compared to taxable profit, but the company will not pay anything extra to the tax authority. It will be adjusted whatever it has been paid earlier. So in the books, this deferred tax, whatever it has been paid earlier, 1,350, it will be adjusted in the third year. So on overall basis, we can conclude, going back to the discussion again, there are difference between accounting profits and taxable profits. This difference is due to permanent differences, temporary differences. Temporary differences, two categories: taxable temporary differences, deductible temporary differences. In the deductible temporary differences, your taxable profits are higher as compared to your accounting profits. In the taxable temporary differences, your accounting profits are higher as compared to your taxable profit. We have looked in the reasons. What is the reason? Due to for the deductible temporary differences, the reasons are might be your taxable income is higher as compared to your accounting income. Might be your taxable expenses, tax allowable expenses are lower as compared to your accounting expenses. Might be your carry forward credits, and due to which this will arise the deferred tax assets. Deferred tax asset that these taxable deductible temporary differences will have impact in one tax period, and again it will have impact in the any subsequent tax period as well. And we have looked into the examples of 3 different types of example, how this deferred tax asset will be created, how it will be booked into the books. Now look from the IFRS point of view as well. IFRS says temporary differences between the carrying amount of an asset and liability in the statement of financial position and its tax base. This is a little bit technical, but overall I can say basically the difference between carrying amount and tax base. What is tax base? We'll discuss sometime else. So this is the difference between these will create taxable. This will create temporary differences. As we said, these temporary differences can be taxable temporary differences, deductible temporary differences. We have looked into various examples for these temporary differences. Then IFRS says these taxable deferred tax assets will be booked subject to the condition company has taxable profits in the future. If the company has taxable profits in the future against which these deferred tax assets will be adjusted, then the company can book these deferred tax assets. Otherwise, company cannot book any deferred tax asset. So this is over from my side. If you have any question, you can drop us an email at info@crestcooper.com. Here is our email address. You can give us a call as well, 3391 488. Thank you very much. If you have any question, you are most welcome.